grab a comfortable seat. You will need a camera phone because you'll want to take images of some of the things I'm going to show you on the screen. And we will also, now that we're live, welcome one and all. Let me know that you can see me. Sorry that I'm a little bit late getting to you today on this. Just a few technical hitches, but it's going to be well worth the wait. You're going to love what you're about to see as well. Let me just move things so you can see things a bit better. There we go. And let me share my screen. Now, you're going to need a pen and paper. I hope you can all hear me loud and clear as well. We sometimes have audio issues, but welcome everyone from all the different parts you're on. If you see me looking off camera, it's because I've got multiple screens. In fact, I might just do this because it's a bit easier, I guess, looking that way. So I'm looking right at you right now. We have got Rod from Taunton, John, Tenzin. Sorry, it was a bit short notice as well, this one, in future. And it's great. Audio's loud and clear. So, like I said, a ton of things. I've actually got 170 slides to take you through. So this is going to be the only webinar you need ever to watch all year round, I think. For those who don't know, let me know if you're first-timers on here as well. We've got quite a few numbers on here, so it might be that we do have quite a few first timers on here as well. So just a bit about me before we do. I got an email just before I started, where somebody said, this is too difficult to do yourself. To invest yourself is too difficult. And I thought, well, no, it's not. There's so many brokers out there whose job it is to make it easier. It's why the government created ISAs and self-invested personal pensions to make it easier for you to be able to do. And if you find it too difficult to do it, then it must be that I'm not doing my job right. So I must improve. Okay. So we know it can be done. And for those who don't know, and you might invest in a general investment account, you might do it through a SIP or ISA to manage your own pension. You might not want to manage your own pension. You might just want to have investments outside of it. But certainly if you're doing it here, that I stole this image from one of the brokers. Brokers are great at explaining things. They spend lots and lots of money with designers and the like. And the reason they do that is because it's in their business interests to make sure they're explaining it to everybody. So, you put 80 in, government puts 20, 100. Now, that might change after the budget. And wherever you're watching this in the world, whether you're in New Zealand, as some of our clients are, or whether you're in Canada or the UK, you all have the same pension issue. It's not growing as quickly as you want. And I'm going to explain institutionally why that's a problem. We're going to try and solve that, as well as give you some stock ideas. Now, everybody wants stock ideas, but I want to try and move you a bit away from looking at individual stocks to looking at portfolios as a whole, because it'll reduce your risk and make sure that you don't panic or get bored. Panic and boredom are the two things which will kill your investments. Okay. So that's what we're going to do. Now, this is why I want you in this webinar. What I'm going to talk, I know I'm going to talk about stocks. Everyone always wants to say, give me a stock, give me a stock. It's as if they want somebody to be throwing things at them. But I want to improve your ability to invest and improve your pensions and mortgages over the long term. So I'm going to show you a lot of amazing free tools on here. And one of the things that I want to get across to you is something you might not have seen. Harry Markowitz got the Nobel Prize in economics for this. What you see on screen is why he got the Nobel Prize in economics. Okay. And I don't even think it needs an explanation. I think it's a work of genius, what you see on screen. And essentially, that's why we want to think about portfolios and not stocks. If you think about stocks individually, then what's going to, and obviously a portfolio is made up of stocks. When you think about a stock, what would happen is, let's say you had investment A, you're going to panic. Okay. When it drops, as you see with investment A, it dropped. Even if you had investment B, you're going to get bored with investment B because for a prolonged period of time, investment B didn't give you a return. So investment A caused you to panic first and investment B caused you to get bored. Both of those caused you to leave your investments, have mental health issues because financially you were thinking, oh my God, this is not for me, and make you chase another newsletter, another online tip sheet. Okay, another journalist, God help us, right? You've decided to put your children's inheritance, your financial future into the hands of, oh my God, a journalist, right? Now, why is what he said genius? Well, because what he's saying is when you get to, and it's what Warren Buffett says as well, when you get to combine both those investments and put them in a portfolio, guess what you're left with? You're left with the exact same return, but without the panic or the boredom. That is what we're trying to do. Now, when you try and do that with 20 to 40 investments, hey, that's a different kettle of fish. That's when, of course, it can get, a little bit trickier. Let me just move those other things out of the way slightly. That's when it gets trickier, and I'm going to come back to those other things in just a second. Now, why is this probably the most genius thing that I could ever show you? Not me, obviously, but what I'm showing you there. And I'm also going to show you how we get to that, okay? How do we get to that? And I'm going to share on my screen how we get to that level of what we're trying to achieve in the simplest possible terminology. This. We go through 10,000 companies, and of course, at one end, we want to make sure they're not correlated with each other. Where is it? Where's the correlation? There's the correlation number. As much as possible, we want to try and avoid that correlation. That is why the stocks that none of these meet our criteria, because they all need to be green. All that ever anybody on one of my webinars is a concern about, give me a name. I happen to own JP Morgan, but I bought it when it was all green. The fact that it's now come off green on one of them doesn't make me sell it because I'm not trading. It means that I hold according to a process. It's the process that makes you money. It is not the gambling and the jumping in and out. Everybody always wants to know individual stocks. And by the way, all I've shown you, none of those stocks meet our criteria. As of today, I wouldn't be buying JP Morgan today, but I'd hold what I've got because I've done rather well. I think it'll continue. That's also the paradox of investing. If you were to keep changing every second, you'd be trading. We're not here to trade. What we're here to do is create what you see on screen. And the way that sausage is made going upwards in that direction is through the ugly bits of A, B, C, D, all the way up to 20 to 40 stocks that go in it. That's in simplicity what nobody's ever taught you what making money is about in investing. We're trying to reduce risk or volatility and remove panic and boredom, and we're trying to get the upside move. Unfortunately, private investors are fixated on A, B, C, D and what goes in there and not the portfolio. If they looked at the portfolio the way a Warren Buffett does, then they would be far more successful because they'd be less prone to panic and less prone to boredom. I also want to show you this from Goldman Sachs Wealth Management. And I show my clients this, okay? It's not mine. I've published it in my books. If you want copies of my books, I will make those available as well. Let me make sure I make those files available. Let me share that book for those of you watching this on the webinar. If you're watching this on social media, you'd have to be on the webinar to get a free copy of the book. But anyway, that's an aside. What I want to say to you is, you can work out where you are on this and say, right, okay, Alpesh, in that case, I'll have 50% of my money in cash and 50% in stocks. And of those stocks, and now we're only worried about the stocks bits. So of those stocks, I'll have 20 to 40 stocks. Why 20 to 40? This is the reason why. Bang. And when I select those stocks, which is what we're going to talk about, how do we find them? Which ones do I like at the moment? I want a portfolio which looks like this, what you see on screen. Okay, now why am I showing you the building blocks? Because I think once you understand the building blocks, you sort of understand where everything fits in, and then why it all makes sense, and why we spend so much of our time, energy, and effort in the hedge fund industry trying to get to this. Okay, because if we presented our clients with just an A and a B, they might just say, oh my God, that's really volatile and risky. Right. So made that point. So when we create portfolios for clients, top 10 portfolios, annualized return is only one aspect of it, because return itself, you might think, oh, I can take any return. I'm brave. But when you get those falls and drawdowns, you're going to panic. Or if you get prolonged periods of poor returns, you're going to get bored, like in 2022 when we had to be in cash for most of the year, because if they're in a stock worth buying, they're in a stock worth buying, whereas Fundsmith and everybody else kept you in the markets, and that's why they've been generating slightly more than 5% per annum for the last 5 or 6 years after inflation. 5%. That's their annualized return, because they have 4 good years because the markets go up in 4 years, and 1 bad year where they hold cash. Well, we're happy where they don't hold cash. They drag it all the way down. That's why Scottish Mortgage Investment Trust have blown people's investments up. So what we're trying to get across to people is what you want to do is make sure, based on your risk appetite, reward appetite. Everybody's reward appetite is 1,000,000,000% per minute, please, Alpesh. Your reward appetite, this y-axis, is not what matters. What matters is your risk appetite, okay? Your risk appetite, okay, is what matters. And that's this maximum drawdown. Why? Because it would make you prone to panic. Well, wait a minute, Alpesh, I've got a house, you might say. And if I checked what the price was every day, just because the price of the house has dropped in a year doesn't mean I panic. Yes, I know. And that's how you should treat your portfolio, but you don't. People panic with portfolios. They don't with house prices, because nobody ever comes around and sums the price every day. But brokers are constantly feeding you prices and portfolios, and newsletter sellers are selling you data every single day because they want to get you to trade and panic, because they sell more subscriptions that way. All right. Whereas you want to be more like Warren Buffett, sit back and go, nope, you're not going to make me panic, mate. Okay. And that's what we're trying to do. Now, one portfolio here, which we call Dinshaw portfolio, which is all the way up there, well, that's got higher drawdown, so he's fine with that. I would love to have something with great annualized returns and hardly any drawdowns. I'd get the Nobel Prize in economics if I could invent it. And this is what we mean by risk and reward. Okay, so we'll break this down and go through it. Chetan, have you missed anything? Yes, you missed the bit where I discuss how to easily make £1 million. Never mind. Now, let's go forward on this part. Okay. Again, because people are so focused on individual stocks, we had a little game we used to do where we used to give clients, for picking stocks which have gone up over 100% using our filters, we'd give them a medal and stuff. And it got me a bit worried. I mean, Ravi got 4 in a year. Medifast, Etsy, Crocs, and Wisdom Tree, the ETF on Brent crude oil. That's an aside. The point is, I still want people to think in terms of portfolios. I know talking in terms of stocks is sexy, and I'll tell you some of the stocks which are in my portfolio, but the point is, when you think of it that level, you're less likely to panic. Now, I'll give you another example. This is what we call our Quality 5 portfolio, and there's this many stocks in it. Okay, there is about 38 odd stocks, I think, in it. Now, here's the interesting thing. If you were to hold it even during a market fall, which I don't recommend, and in 2022, as people will know if they watch my YouTube channels, we were in cash, then this is what would have happened with the individual stocks. Each one of these represents an individual stock name that I've blanked out. Okay, so I've redacted the stock names. I forgot to explain that to somebody once, and they didn't know what this was. So that's the year. So in that year, one stock went down 64%. I think it was Meta, actually. Now, we were in cash across the board, but let's say you had a car crash and you didn't do that, then this is what, again, another stock, another stock, another stock, another stock, another stock. But as a portfolio as a whole, guess what? As a portfolio, you had that, even if you held and ignored my education and didn't hold cash. That's what happened. The next year, you had this. Now, I wish, as a portfolio, you had 56%. I wish I told students Meta was going to go up 194%. I didn't know it was going to go up 194%. Okay. But because it was part of a portfolio, here's the pros and cons of thinking at the portfolio level. You won't make as much as your biggest gain, but you won't lose as much as your biggest fall. So we then say to students, if you take this portfolio and put it into the portfolio level since 2017, the Quality 5 Plus, guess what? Your worst ever drawdown from peak to trough. That means if you started with £100 and it went like this, whatever, the biggest drop from the high point to the low point was just 13.6%, even though the individual stocks within there might have dropped as much as 60%. During that period. Why? Well, because you'll not put all your eggs in one basket. Nobody ever breaks this down in an extra and explains why it's important. This is unlikely to make you panic. Okay? Everybody wants this. That would mean doubling your money every 2.5 years. And I say to students, let's assume history is no guarantee of the future, and you only do half of that. If you do half of that, you still double your money in 5 years. Okay, so 1 million in 5 years becomes 2 million. In 10 years, that becomes 4 million. So 1 million has become 4 million in 10 years. And in 15 years, it's become 8 million. And in 20 years, it's become 16 million. So in 20 years, 1 million has become 16 million. If you get half of that, which is 15% per annum, which has actually been the 15-year average of the S&P 500 anyway, so I'm not actually saying anything clever. Now, the problem is, why don't people do that? Because they panic and they get bored, which is why Warren Buffett geniusly says his holding period is forever, because the implication of holding anything forever, even though he doesn't hold things forever, is I won't panic, I won't get bored. But you can only do that if you've got good quality companies, right? So whilst when we create this, like for my son and for my wife, what we try and do once every 7 years, it happens, is stay into cash in years like 2022. Okay. 2018 didn't happen. So it took a 25% drop there and this drop here and there. Well, why couldn't you get more than 7%? I'm sorry. You take my place and go and do it. And good luck getting your 32% as well. The problem is private investors try and pick individual stocks. And when an individual stock drops, they panic and they worry, as opposed to thinking, is it a good quality company? Everything else is noise. Okay, so the fact that, for instance, I've publicly disclosed I hold the 2Ms and the 3As, Meta, Microsoft, Apple, Amazon, Alphabet. I also own, as it's publicly known, JP Morgan and Goldman Sachs. The fact that I did put it into any one of those companies, all my money, means that I too am not sure which ones are going to do incredibly well. And the fact that Goldman Sachs over the last 12 months did better than my NVIDIA holding proves the point that we're not trying to focus on narratives and stories. Now, that's very, very different to what anybody else tells you, but that is what a Warren Buffett does, and so on. I'll mention other stocks that I like going forward. Okay, so portfolios is what it's about. And I have to say, without getting too technical, one of the things that we look at is we look at the statistical movements of prices to make sure that the downside is as low as possible, because we want the kind of stocks that if they drop, they rebound really quickly. That's what you're after. You want your drawdown depth and duration to be as little as possible. That's your ulcer. Your ulcer index is your drawdown depth multiplied by the duration in months. So a 10% drop multiplied by 20 months to recover is an ulcer of 200. You don't want an ulcer of 200. Obviously, ideally, you want an ulcer of 0. Well, guess what, my friends? Doesn't exist. And we want that measured at the portfolio, not at the stock level. If you measure at the stock level, it's always going to be more volatile than at the portfolio level. That's why portfolios are important. If I had to say there's one formula which is really important for me, is this. A minute, Alpesh, you're talking statistics and maths. You didn't mention narrative stories, AI, quantum computing, and tell us how you know on an inside story with amazing passion, the passion of a newsletter selling journalist, that, oh my God, you've got to get this, get my secret alpha newsletter, because I will tell you some high beta stock which you can gamble with your money, all the while paying me a subscription. Are you stupid? Really silly that you want to do that? Would you not rather actually look at the statistical movements of the prices and look for undervalued revenue growing companies? And then when you mix that at the portfolio level, of course you're bloody winning. Of course you're winning. And it's one of the reasons I launched my campaign for $1 million. Here's another formula which I love. I love formulas. This is from Goldman Sachs Wealth Management. And it is cash return on capital invested. Okay, so we have that because companies in the top quartile by cash return on capital invested, there it is, has to be green for us. If it's not green, we don't want it. We want this to be green, all of these to be green. If any of my clients are watching, I'll only say this once, before you have a heart attack, none of these meet our criteria, remember. So don't say, oh my God, you've shown the holy grail. It means you're not paying attention, you're sacked. Okay. We need all of these to be green. And the reason, Sortino, I've already mentioned, high average return, low downside risk. In other words, snaps back quickly. Not guaranteed to in the future, but at least we want to tick that box. Cash return on capital invested, as well as my value growth income, has to be green. Why? Because we're trying to avoid mistakes. That's why we need to look at 10,000 companies, 10,000 CVs. Now, companies in the top quartile, by that, generate 30% per annum as a basket, not individual stocks. Some might do more, some might do less. And in crash years like 2008, nobody does well in that. Okay. But overall, that's why we're looking at portfolios. That's why it's critically important always to be looking at the portfolio level. Now, the other thing we're not doing is this. We're not there as a newsletter vendor to try and say to you, this is going to go up tenfold. That's not my business. It's not the business of Warren Buffett either. And let me tell you something. Buffett never had a single year where every single one of his stocks went up, and never had a single year where his holdings were in the top 10 biggest risers of that year's stock market. And similarly, I'm not there to be in the business of finding what are relatively small companies and then speculating your money on it and saying to you, please pay for my newsletter and I'll give you the names of things you're taking risk with your money, all the whilst paying me to do it as well. Well, that'd be the easiest game in the world. I'll just pick a load of stocks under $5 with high betas, which is high volatility, high correlation to the S&P 500, and an extremely high low liquidity and an extremely high volatility rate. I'll just pick those and I'll feed you them, and then I'll give you 20 of those. The 10 that go up, statistically bound to and go through the roof, I'll put them on a list and say to you, get my newsletter. It's how newsletters work. Okay? And they'll measure the hour. Don't do it. If you do that, it's fine, but it's like going to Vegas. And that's okay. But there's a reason why Warren Buffett became the world's richest man not doing that. Because actually, it'll make you feel good for a short while, and then you'll blow up. You guaranteed you'll blow up, okay? Guaranteed. What we're trying to do is this. Private investors, believe it or not, try and do this. They want every single stock to go up. So if they pick a stock, and let's say the stock drops 25%, which, as I've just shown you, and Warren Buffett said he's had his whole portfolio has dropped 50% at times, and say the stock drops 25%, despite the fact that they're in a portfolio generating 32% per annum, they will panic because they'll look at it at the individual stock level because they're trying to be perfect and make sure every single stock goes up. Or at least I don't mind it dropping, Alpesh, as long as it's gone up loads before. Or I don't mind it dropping as long as my whole portfolio has doubled. Then if one stock drops 50%, that's fine. In other words, they're just trying to be perfect. We're not. We're trying to be patient. And the best way to be patient is to have a bunch of quality companies. So we'll talk about that. And one of the other reasons why patience is important is because statistically, we know that'll be the case. Look at this. This is the change in the S&P 500 90 days after each one of these massive market-moving events, 90 days later. What do you think happened within the first 30 days? Well, not only did the markets fall, but the journalists were all shrill and screaming, buy our newsletter now. Oh, the markets are going to die. This is going to happen, and so on. And so on. That's what happens every single blasted time. Let's talk a bit about the markets then. I want to start off with, well, what's happening? Is there anything in the markets at the moment which is worrying me? Well, NVIDIA's profits are through the roof. I'm not there to gamble whether or not they're going to be outcompeted. That's for the board of NVIDIA to worry about. So I don't mind holding that, all my other stocks. The China trade negotiations are ongoing. They're not worrying the markets. Interest rates, the carrot that they're going to drop is still there. AI, robotics, quantum, all of that, all fine. China, Taiwan, no invasion yet. It's brewing in the background. There's nothing worrying us. Trump tariffs, the Supreme Court might rule them all illegal. I don't think they will. I think they'll find a way not to crash the market on that one. The S&P 500's at all-time highs. Now, I'm not trying to sell you the S&P 500. If I had to go into cash, I'll explain to you when I do, I would in a minute. If I look at the headlines, there's nothing which is making me currently worry. But this is what headlines do. NASDAQ 100 set for worst week since April meltdown. Oh, my Lord. Well, we're going to look at it in a minute. Why do they do this? Well, I used to work at Bloomberg doing my TV show. I've got 200 shows on Bloomberg television. And I can tell you the reason we do it is not to try and panic you. We're actually quite responsible at Bloomberg. The reason we do it is we need your eyeballs, mate. We can't just sit there and go, hey, guys, nothing to worry about, really. Things are a bit boring. Well, actually, we did used to say that. But most people, we want eyeballs. Because why do we want eyeballs? Because it gets sales. Marketing. All right. That's why we want eyeballs. Fed December rate decision won't come easy. Shutdown. That's all great for panic. But I'm not here to trade. I can do a trading webinar some point in the future, but we're not here to trade. Okay. Balance of risk favors stock bulls, Goldman's Pascalurillo says. Fine. Great. Okay. All right. Is there a red flag I can see here? No. Look, apparently the Brazilians have got a rare earth, but everyone's got rare earth. Suddenly they've discovered that they didn't realize that they had. Not just the Chinese. Right. Now, what else have we got? I happen to own some Ripple. I'm not going to talk about that. I happen to own Bitcoin. Hedge funds ramp up crypto use after Trump's regulatory push. I can tell you one thing about him, because his head of crypto policy, my wife used to work with in the UK, who used to be at Anderson Horowitz, the number one VC firm out of Silicon Valley, he is very pro crypto, not least because his family's making a shed load of money out of it. But just as an aside, crypto, it's like modern art. I don't know. It might be worth something eventually, it might not. But my God, do people have strong feelings about it? If your investments make you angry or have strong feelings, then maybe consider a different set of investments. It's the same with religion. If your religion makes you angry, maybe consider a different religion. And for some people, their investments have become an act of faith, to the extent that if somebody attacks Bitcoin or anything else, they go berserk, which makes you think that maybe they don't believe in what they have so much faith in to begin with. So there isn't anything on the news which is making me in the slightest least bit worried, if you see what I mean. Okay? I could talk about bond sales out of China, but really, is it moving the markets at the moment? And I'll tell you the best way in which I've ever, over the last 25 years, and I've been consistent both on my Bloomberg TV show and also in all of my 18 odd books. And I'll show you I've been a better predictor of whether I should go into cash or not whole scale. And it only happens once every 5 to 7 years that I need to. I'll come to that in a second. Where are we on some of our client model portfolios? We create bespoke model portfolios for them. And year to date, and this is unusual because our quality 5 is slightly lagging the S&P this year. Now, this is when social media go, oh, you didn't beat it. Well, wait a minute. Are we trying to beat the S&P every minute, every second, every day, every month, every year? Or is it completely irrelevant, as Warren Buffett has said in Benjamin Graham's book, that, well, that's like trying to beat the neighbors. Well, what about the fact that we have, over 2 years, you're ahead. Over 2 minutes, you're not. The race actually isn't against somebody else, just as in life, it's against yourself. So I'm not too bothered because actually I can sit back. This is the best profession in the world. Most of the time, you're just sitting back and doing absolutely bugger all. I mean, I could, over the last 5 years, have just come out once, twice, January 2022, and said, yeah, doesn't look like there's anything good. We'll just keep holding cash. And then December or January 2023, as we did say, now the average prices are rising. I think we'll get back in. And that's it. But why do we do so much? Well, because people want to keep hearing. And what I keep telling them is do nothing, do nothing, do nothing, do nothing. People hate doing nothing. And why are there variations in different client portfolios? The reason there are variations in different client portfolios is because there are variations in different people. Some people want lower drawdowns, and it's the drawdown that's the trick. You see, people think it's all about maximizing returns. It's not. It's about minimizing drawdowns. Then you maximize the returns under the constraint of minimize drawdowns. Anyway, we'll go into some of this and what's in some of these. I'll tell you what's really stood out is the European stocks. And I probably need to do a separate webinar just on European stocks. They really have been phenomenal this year. And we had one client, Kanesh, who said to us, well, what about European stocks? So we created a model there really for him. And that was the critical factor there. People sometimes say, I want low risk, so I want ETFs. Yeah, the only thing is you're going to get lower returns. I'll tell you what else is unusual this year. It's very unusual for the UK ever to have a 20% return, because mostly it swims around 9, 7, next to nothing, negative. That's very unusual, what we've got so far. Okay, and it'll probably revert to mean. But you know what's going to happen? A whole bunch of fund managers are going to start advertising the fact that, you should be in the UK because they had one good out of sample aberration year. Consistency is what's key, and it consistently doesn't tend to do that. So that's interesting. I should also explain what AI picks are. AI picks are picks where we've uploaded all our data into artificial intelligence and then asked it to go through all the literature out there. All the most important literature out there, and take all our data, and then come to us by weighing these criteria based on the academic literature, the Nobel Prize winning literature, and come back to us with stocks which it thinks will be the best. And that's what AI picks means. It doesn't mean stocks in the AI industry. It means artificial intelligence selected the stocks, and that's how the portfolio has been. Okay, so obviously, you could argue, well, in hindsight, Alpesh, wait a minute, aren't your wife and children in the Quality 5 Plus? Should you not, in hindsight, have put it in AI picks? Yeah, in hindsight, there's a lot of stuff I could have, would have, should have done. Maybe should have put it in there. But we're not going to go portfolio hunting and sort of, well, I'll do this, I'll do that. One thing that I have done, I've got a big extended family, is have different members of the extended family in different ones. So some of them can fight with other ones about which are better. Now, I want you to make a note of this. These are the 10 commandments of investing. Just want to make sure everybody can see everything from the screen. I'm also going to publish a poll on here. Just continue letting me know you can see me loud and clear, because sometimes I get worried that maybe everyone's falling asleep or something. Okay, 10 commandments of investing. Now, I'm not going to go through these, but this is essentially what I am always telling you all. I'm going to pick one of these. The single pick gamble, this one. If you buy one stock from the filtered list, then you are gambling. It is the one. Please look at things and the portfolio level. And we tell this to clients because we discovered that clients thought just because something's been filtered by undervaluation, high growth, revenue generation in Sortino Alpha, all of those factors, they thought everything must therefore go up. And we realized, oh my God, they're not thinking of it at the portfolio level. They think at every single individual level. So it's like, hey, take a breath back. Warren Buffett hasn't had a winning stock, hasn't had a portfolio where every single stock has been winning any year of his existence, and he's 95 now. Okay, he's always had ones which fallen. You know, if we could see that far ahead, the implication of that would be, oh well, in that case, why don't we just tell you to buy one stock, the one which is going to go up 1 billion%? Okay, so that's where we are with that. I also want you to take a photo of this if you wish. Anybody who are my clients will know that I don't mind sharing my education. I'm obviously limited to how much I can tell you about what's in the model portfolios because they're client specific. But in terms of teaching people, as I've done in my books, this is probably an important thing. And I've been asked by some publishers to do more books. And if I do, then this slide will definitely go into it. So I do want you to take a bit of it, because that's the one major question you're going to ask. What should I do? And you start with one. Well, you ask yourself, if I sell now and the market rises further, how much would I regret missing out? You see, what people think about what should I do is they think it's about being able to see into the future. Alpesh, can you see into the future in your crystal ball and tell me which way this stock's going to go? It's not. It's about regret minimization. And usually what's happened is when by the time somebody asks, what should I do? It is because, first of all, they're not thinking straight. Secondly, they've put too much money in something. When you put too much money in anything, it means you're gambling. That definition is gambling. Okay? And it means you've overdone it. And you might as well, wait a minute, what's the fun in that then, Alpesh? If you don't put too much money in and put it all on black and become a billionaire quickly, what's the fun in living? Doing things slowly? Yeah, I'm afraid so. I'm afraid so. Yeah, if there's a great rich quick scheme, I'll let you know if I come across it, but I haven't yet. Okay. Wish I had. This is the closest there is to it. Can you all see the poll on here? As well, has been slightly hit this week due to, well, don't look at it on a weekly basis. Why would you do that? We're not in a daddy bear, Chetan. You should know that. We're not in a daddy bear. Flipping out. How'd you go from, see, that's what I'm talking about, Chetan. You're looking at for a week. Why? And now you've gone from 0 to, is it a daddy bear? It's like, oh my God, should we just hit the nuclear button? We're nowhere near it. We'll come back in. That worries me because it means too much on the panic side. Why have you got IAG? Certainly not one of ours. Where'd you get that from? Or Venu? Venu's not one of ours. Or the Bitcoin ETF is not one of ours. Yeah, no wonder you've been hit. Probably hit by Bitcoin for a start because of the past month. It's been bloody awful. Oh, you can see the poll. Good. Okay. Better have a chat, Jethan. We're better have a chat. You seem to be diverting a bit off the program. If I hold or buy now on the market falls further, how would I feel? So this is important. And why I say that is because it comes from Nobel Prize winning research from Daniel Kahneman, that decisions are better off made by regret minimization as opposed to a crystal ball, which would mean gambling. Okay. That would mean, you're not on the program. No wonder. I'm sure I'm telling you myself, I'm looking overall, I'm up 20%, it's not paying it. Okay. All right, Chetan. Investor strategies for different risk appetites. Now, this is the other thing. I'm not this. Now, this is a good way of deciding how to get in. Okay. I'm usually most of the time this. 12 months is probably too long to be this. Most people are this or this. Okay. Very few people are this. The ones who are this are usually just sat on they're the people at the train tracks watching a train go by, hoping it's going to reverse and come back and pick them up. Okay. They're not going to, they're just forever. They've been waiting for a stock market crash since 1980. Right. And they got one in 87 and they were happy that they just stayed out of the markets for the last 50 years. Right. It's just how it is. The ones who are here have one hell of a ride. And I should say it's a minority. Now, you can see the draw. I mean, take a picture of this because it's a very good way of deciding to get in. If you're deciding based on your appetite, it's a lot more sensible than deciding based upon trying to see into the future. Okay. And I also want you to look at this. The markets aren't falling yet, despite those headlines from Bloomberg. But when they do, all the retail clients are going to do path A. They're going to do path A. My clients are going to do either path B or path C. Okay. Well, how do they decide whether it should be B or C? Now, B is if they are more than happy just to hold. Some of them are, even if it's a deep decline like in 2022. And path C is going to be for those who want to pay the insurance of not being in case it's a deeper fall, i.e. they exit, they might have to buy back more expensive later. That's the insurance premium. So they just decide, they make the decision binary. Do I want to pay insurance or not? If the house burns down and I haven't paid insurance, i.e. gone into cash, then that's all on me. If the house doesn't burn down and I didn't pay insurance, I'll be glad I didn't pay insurance and didn't have the extra cost of insurance, i.e. buying back more expensive later. So in hindsight, to give you an example, in 2022, it was better to have exited, i.e. paid the insurance, because you were able to buy back cheaper because the house did burn down. But in 2025, it was better not to pay the insurance because any falls were led by quick recoveries and you would have had to have bought back more expensive. But guess what? Those decisions only had to be made once in 2022, once this year. That was it. So have you noticed how we made the decision making a lot simpler and such that you're happy whatever decision you make because it was aligned with your risk appetite, which is a hell of a lot cleverer than going down path A, which is what most retail clients do. And you're more than welcome to take a photo of this. Although it's for clients, we don't mind doing that. Okay. Gordon, I'm going to do that. I'm going to explain. Daddy Bear, you read my mind. It's about to come up. Okay. It's about to come up. So the very next slide, take a picture of this if you wish. Again, this has been in my books before, not this exact image, but the basic fundamental principles of what I'm explaining. So it's not something which, by the way, I'm not trying to sell you my book. I get £1 in royalties, or any of my 18 books, I get £1 in royalties, which is fine when you're number 2 on the Amazon bestseller list behind Harry Potter, which happened after I was on Tonight with Trevor McDonald back in the year 2000. But on a year-to-year basis, who cares? Okay. But here's the thing. Let me just come back to that poll. 55% of you think the FTSE will end the year higher from today's levels. Fine. I'm not gambling either way. I'm not here to be Ladbrokes. I don't want any of you to gamble. But what about the Dow or US markets generally? Higher from today's levels? Let's see. Most people have what's called recency bias. In other words, if they see the market falling today, they're more likely to think things will be lower by the end of the year. If they see it rising today, they're more likely to think. So recency cognitive bias there's a lot of cognitive biases the human brain has which lead to bad decisions. So where are we at the moment? Well, we'll have a look at the moment. But from my last recollection, we're at 0.1. We're still at 1. And you can read it here. Rising monthly MACD, but overbought. Risk averse would be cautious or stay out. Risk neutral would add to winners cautiously. Risk loving will buy because risk loving always buy. Do you notice how I made the decision-making process simpler? Are you risk-averse, risk-neutral, risk-loving? When you simplify, when you've got a lot of information, but you can simplify and categorize and make the decisions binary or on a sliding scale, it means you can move a lot quicker, okay? there's a 70% chance of a 10% drop in the next 6 months. Please remember that. I've said that. Hey, Alpesh, wow, you're incredible. You called it just right because it's going to happen. There's a 70% chance of a 10% drop in the next 6 months. Got it? But we're not trading. We're not gambling around that. I might hold through it, right? So we're at 0.1. We're not at 0.2, which is a flattening MACD, and we're not at 0.3, which is the or at 0.4 where it's a daddy bear, 0.3 where it's become a mummy bear, i.e. the MACD is falling. So 1 is where it's rising, 2 is where it's flat, 3 is where it's falling, 4 is where it's crossed below its own moving average. It's all on the screen. You can see it there. Made it very clear. You can read the text, read the text, read the text. Okay. Currently watching on TradingView on the weekly time frame. Well, the monthly MACD is above the signal line, but it's below on the monthly time frame chart. You want it to look like mine. I don't know what your screen looks like, but I'll show you what mine looks like. Okay. This is what mine looks like. All right. So that's the weekly. That's the weekly. And that's where we are. It's rising. Now, if you are very risk averse, you would start taking some of your profits. I've not said anything novel in saying that. Think about it. I've just stated the bloody obvious. If you are risk averse, you would take some profits. Why? Because you're risk averse, right? If you are risk neutral, you'd cautiously watch it. If you're risk loving, you'd stay in. You've only got 3 decisions to make. Let's simplify life again. Buy, hold, or sell. The problem with retail clients is they have a crazy desire to pick the exact top and bottom of a market and be greedy. If you're worried, if it drops X, sell Y. If it drops X, sell Y. In other words, if it drops 10% or 15 or 20 or 5, sell Y. Work out what your Y is. For 5% drop, you want to sell what? 100% if you're risk averse, or 0% if you're risk loving, or a sliding scale in between. If it drops 10%, write those numbers out before. That's your war plan. Always make a war plan while you're calm, cool, and collected before the battle ensues. So there you go. What you're asking for, not you, anybody specifically, what retail clients ask for is, tell me the exact numbers. What should they be? If it drops 5%, how much should I get out? Because you can see into the future, Alpesh, with your time machine. And I've been in the future, and I can tell you it's very foggy. Okay? So that's the point. Do you notice I'm helping you make your decisions with greater clarity? You didn't even know I was here for that, but I am. That's what it's about. So if you're risk loving, would you buy more? Yeah, because this is rising. If you're risk averse, would you buy more? Of course not, because you're bloody risk averse and it's overbought. If you're already in, would you buy more? If you're risk loving, you would. Otherwise, you'd hold. Would you sell? No, because it's not a daddy bear. What can you do then? Alpesh, how do I work out what my risk appetite is? Well, if you're risk loving, you'll only get out once it's a daddy bear, i.e. the crossover occurs. If you're more risk neutral, get out on a mummy bear, i.e. that's falling. Is it perfect? No, of course it's not. If I'd worked it out, it's perfect. I'd be a trillionaire. Okay. Could it keep rising up? Of course it could. Is the past a guarantee of the future? No, of course not. Of course it's not. Thank you very much, Kavita. It's my pleasure to provide it. I've been doing Kavita. I wrote my first book. No, this is not the first book. This is an international bestseller published by Palgrave Macmillan with hedge fund managers and Bloomberg TV and Sky News giving me great reviews on the back. Wrote my first book in 1997. Been giving free content. Where have you been all my life? I've been giving all this stuff. And by the way, it's not changed. All that's changed is time has moved on, but the same analysis. And I first came across this. I didn't invent this. Gerald Apple invented the moving average. I first came across it when I finished my university degree in 1995. And I spent the summer in the Bodleian Library and just getting various books, and then came across this and thought, oh my God. And then I've looked at all sorts of other ways of deciding whether to get out or not, like macroeconomics. I have a master's degree in economics and politics and philosophy. So philosophy, politics, and economics. And I have a degree, an undergraduate degree in law. And I can tell you all of that is useless compared to just looking at this. This is as good. This is good enough. There is no perfection. Retail clients want perfection. Why? Because they're gambling. Retail clients are gamblers. How do I know this? Because there's a bloody Ladbrokes in every single high street in Britain. That's how I know the average retail person is a gambler. It's very simple. You never see billionaires walking into bloody Ladbrokes. You might occasionally, but usually not. There's a reason for it. Now, where are we? That's where we are. What do you want me to tell you? Oh, what's the future hold? Oh, let me put on my gypsy hat on and that's probably racist now. but let me read your palm what the future holds. I don't bloody know. I can make a good guess. If I was on the BBC, I'd make an intelligent guess because I've got to sound intelligent on there. All right. What's this? Don't panic. There's a lot of red. Don't panic. What is all that red? You're paying $27 when you buy Microsoft stock. You're paying essentially $27 to own a stock in Microsoft for every future dollar of profits that are expected Microsoft to generate. Okay? Expected by who? By analysts. You're paying $29 for every future expected dollar of profit of NVIDIA. Well, guess what? That's cheap. How do you work out valuation? And valuation is not the only thing that moves stock prices. Projected revenue growth does. How do I know that's cheap? And mark my words, it's cheap. That doesn't mean it can't fall 10, 20%. Oh, yes, it can. NVIDIA can, and I'll show you that in a second, historically fall far deeper. How do I know that's cheap? You know something is cheap by any relative measure of anything, okay? In absolute numbers, well, in absolute terms, 29 and 27 is actually not that expensive compared to, say, a 200. Well, nothing gets to 200. Look at Tesla on there. Yes, it does. So we know in absolute numbers it's cheap. It's cheap relative to other companies. Look at Tesla. Look at on their CrowdStrike, 111. Look at Palantir, 197. So we know it's relative. And you can measure it relative to its own history. That's three ways you can work out if something's cheap or expensive. Well, actually, relative to their own history, that's cheap. Why is it cheap? Why is Microsoft only trading at 27 times expected future profits? Think of it like a house. You buy a house called Microsoft Avenue, and you're getting rent of $1 a year, and you've bought that house for $27. That's what it means, okay? Why would somebody pay $27 for an asset of $1 a year? Well, that's you buy properties for rent. Obviously, okay? It's what you do. When you buy anything, if you buy a company, what you're buying is future cash flow. So why would you pay $27 for Microsoft? Today, well, it's cheap. I mean, what are the other ones which are cheap? Alphabet, Meta's cheap. Verizon is incredibly cheap. Doesn't mean I'll buy it because there are other factors. Am I going to get revenue growth? Walmart and Costco are expensive. I will buy more of those in the future, but not at the moment. Tesla, I just don't own because I don't like the volatility. Man's going to get paid $1 trillion. Karl Marx would be so pleased because he would say, up the workers. Look at that. The employee is going to get paid $1 trillion. The fact that he's also the capitalist. Anyway, JP Morgan I own, it's cheap. Goldman Sachs I own, it's cheap. Morgan Stanley I don't own, but it's cheap. Visa and MasterCard, which they're okay. I don't mind. I've got family members who I've given it to in their portfolios. But the point is, some of these are cheap at the moment. There's no two ways about it. I'm not trying to sell you. Look, whether you buy Microsoft or not, I couldn't care less. I don't get paid. I'm not stockbroker. I'm not going to get commission out of you buying Microsoft from me. I'm not trying to sell you a retail fund. I'm not an exchange traded fund. Voila. I'm not St. James's Place trying to sell you our shitty funds or a pension fund manager who are trying to sell you their rubbish funds. So there's a lot of earnings to come out yet, but none of these earnings that are about to come out where are we? Friday, Monday, Wednesday are going to move the markets. Where are the markets so far? Well, there's a good X-ray. That's the S&P. Now, I always get people going, people who think they're clever but really aren't. And one way you can tell when it comes to investing is they'll ask, yeah, but can you beat the S&P? Yeah, it's really easy to beat the S&P 500. There's a couple of ways you can do it. One, you can have a 2 times leveraged S&P 500 exchange traded fund. That'll beat the S&P because the S&P goes up more often than not. And they'll go, and didn't beat it over the last 30 seconds. Well, there you go. That's timing is very important. The time frame is important. There's another way to beat the S&P 500, just have more of the stocks which move the S&P 500. What are the stocks that move the S&P 500? They're on your screen. I had the biggest bubbles and the ticker symbols, NVIDIA, Microsoft, Apple, Amazon, Alphabet. They're the ones that move the S&P 500. The other ones don't. Because the S&P 500 is a market capitalization weighted index. It's based not on all 500 companies having equal movements. If one moves up 10%, it has equal weight with one which drops 10%. No, it doesn't. It's based on market capitalization. So the ones that actually move it are those. It's actually an index of those companies. So if you want to beat the S&P 500, really easy, just have more of those stocks. Even simpler. have the S&P 500 index as your core, and then on the peripheries around it, the satellite stocks that you have would be these. Simple, done. One. Why? Well, you can't do worse than the S&P 500 because you already own it, and the ones which are moving it the most are the ones you've got in your portfolio. So there's two ways. So I love it when people on social media go, they think you're a normal retail fund manager who can't. Because what they do, what retail fund managers do, is they own all of this and then add a little bit of something. Well, they're bound to fail statistically. And Eugene Fama got the Nobel Prize in economics for proving it. Retail fund managers in which your pensions are institutionally created in such a way that sadly they will underperform indices that they benchmark. Eugene Fama got the Nobel Prize in economics for proving it. And it's just simple statistics and mathematics. Anyway, for those who think we're overvalued, don't forget all of the stocks here that I've circled are all under 0% return this year. Every single one of those I've circled has generated less than 0% return. And all the ones below the dotted line are under the performance of the S&P. So the Apple and Amazon are both underperforming the S&P. Did I know that? No, of course I didn't, which is why I don't just own Apple and Amazon. I also happen to have NVIDIA, Microsoft, and Alphabet. Did I know the pattern of the bubbles would be like this on November the 4th, or indeed November the 7th, 8th, 9th, 10th? No, of course not. Retail clients try and do that. They try and, you remember spot the ball in football? In the 80s, remember the pools guy and spot, that's what they try and do. Chris, Alpesh, how do you avoid doing what I did with Amazon? Bought in for 98, proud to sell at 150, very pleased with myself, but now gutted because it's 250. I've done this several times. What should my sell strategy be? If it drops X, sell Y will help you, or have a core long-term holding for something like an Amazon, which is a quality company. So clarify the strategy. Why are you selling? Why are you not just holding? Because you might think, well, I want to rebalance. I want to take some money off. So you could say, if it drops X, I'll sell Y. Equally, if it rises X, if it rises A, I will sell B. That might help you avoid the all or nothing decision, which is what a lot of people do. They think they have to sell everything. They don't. They can sell a little bit. Just take a bit of profits and let the rest ride. Until, think of a graphic equalizer, until the sound is just enough that your heart stops pumping. And regret minimization, you asked me, what should I do? I already answered it right at the start. Remember that slide which said, what should I do? That's the slide. And what that will do is, it won't get you perfect. It won't get you perfect as in, oh my God, I've maximized my theoretical maximum amount of money. I've never done that. Warren Buffett's never done it. What it will do is regret minimize, which means you win. I'll give you another example of what regret minimization is. And if, believe it or not, we do this all the time in our lives. Putting on a seatbelt and buying home insurance. They're regret minimization. Has your house ever burned down? No, but she's never burned down. Are you stupid for buying insurance? No. So why do you feel a winner even though you bought home insurance? Even though you wasted all that money? Regret minimization. Because if you hadn't, you'd have sleepless nights. So we are happy to regret minimize. That's what you should be doing, because you can't see the future. Alpesh, is my house going to burn down in the next 12 months? Could you tell me that? I don't bloody know. But I tell you what, mate, you might want to get some insurance. Oh, I'm happy now. Thanks, Alpesh. You see what I did there? I couldn't see into the future, but I told you how to regret minimize, and you and I both felt happy that we're winning. That's what investing is. Do that, you'll be happy, and you'll always be winning. Karen just got out of SJP thinking of 50% S&P, 10% cash, 10% spread over 4 companies. That's one way to do it, yeah. I mean, just general terms. I can't give you individual advice, but, the fact that you got a lot in the S&P. But what you're going to have to avoid is panic and boredom. Rahul, even if very good stocks like Microsoft drops 10% or 20%, I should still follow the procedure on selling X amount, or is it best to hold these? So what I do, Rahul, is when I've got quality companies that I like for my own timeline, I want the kind of companies which when they drop, I want to buy more. Okay, that's a measure of quality. It's the Warren Buffett approach as well. And that's one way. The people who, if it drops X, sell Y, are the ones who are more panicky, have put too much money in and want to trade. Got it? So if you've already got companies which when they drop, you want to buy more, you've got a good portfolio, my kind of portfolio. If you've got the kind where you're a bit more tradey and have put too much money in, okay, like let's say instead of putting $1 million in Microsoft, I put 2 million in, I'd be thinking, oh shit, with the extra million, if it drops X, I'll sell Y because I don't want to, I'm overexposed, let's say. Okay. Or if I put 1,000 in Microsoft, normally I would do, but I put 2,000 in. I think, oh God, with the extra. Do you see when you use the XY thing, you use it if you're overexposed and you're trading, which is what retail clients do. Personally, you shouldn't go down that road anyway. You wouldn't need to if you've only bought companies which are the type you want to buy more of if they fall. Guess what private investors do? They never buy companies which are of the type that if they fall, they'd want to own more of it, not less. Me and Warren Buffett do. I'm not the world's richest man, but he is. And I'm not copying him. It just so happens that that's the journey. I think my son will be well on the route, though, because he's starting sooner and with more than Buffett started at the same age. And I've just got to make sure Rian doesn't F it up. Then it just compounds. Now, and it's not money for money's sake. I keep telling people this. The other very important thing about it is I'm a teetotal vegetarian who rides around on a bicycle, a 300-pound bicycle, not a carbon fiber. I mean, live in London. Bloody hell, you can't even take your phone out, let alone your bicycle out before it gets nicked. You can't even wear a watch in London without being scared. So if you live in London, it's pointless owning a bloody car, so you end up having a cheap bike because everything gets nicked. And if you're a teetotal vegetarian, what the F are you going to spend money on? I'm not kidding. This is not virtue signaling. I made a small donation to the British Legion because it's Poppy Day coming up, Remembrance Sunday. That's what you're going to spend your money on. I'm on a diet. I'm teetotal bloody vegetarian on a diet. I can't even go to good restaurants anymore because of that. So you spend it on personal freaking trainers and good cameras. I love cameras, but they're inside the house. Now, past week, this is noise. This is noise. Chetan, this is noise. Okay, this is noise on there. Oh, let's see. Sorry, there's a big question. Andy, been doing well in investments since mid-2000s. She realizes some money and sitting with a high proportion in cash. She's very risk averse, and I feel I'm struggling to increase the confidence to get more invested. Well, she's risk averse. That's fine. She's risk averse. She is what she is. I would say Flagstone, bank account interest would be a good place to say. It's the responsible thing for me to say, I'm afraid. If somebody's risk averse, then a bank account is the place for them to be, I'm afraid. It's not just the most responsible thing for me to say. I could not say to them, go become risk loving. I'm sorry, I couldn't. Even if I can't say to her, come join me on the roller coaster. Look, we've now doubled our money. Aren't you happy? Because she'll have ulcers in between. It'd be irresponsible to say, yeah, I need help for good starting resources in for a younger investor. What I would say, your 21-year-old daughter, what I would say, good starting resources, but I'm going to give you the best. She can be an intern with me, completely free. Go to campaignforamillion.com. And it's got all my free resources on there, and it'll get her better. And I'm glad she's risk averse because she'll start off that way. Listen, trust me, start off risk averse, then gradually get better. We'll make a multimillionaire out of her. Start off risk loving, you're screwed. She's going to be blowing your money and her money like this. So she's on the right track. I need help with suggesting good starting resources in a younger investor. She's very much a titular, so short attention span for complex ideas. My TikToks, 500,000 followers, short attention span, quick videos, boom, 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 boom. Go through my TikToks at Great Investments. But it's also on campaignforamillion.com. But Andy, it's a very good question. And you've got her on the right track. She should be short attention span. She should be, because that is the way of the world. Don't try and change that. Don't force it any other way. But she can consume that. That's why people like me change for her, to accommodate her. That's why people like me are on TikTok, to accommodate her. We change our behavior to accommodate her. We don't expect her to change her behavior to accommodate me, because that's how it should be. Past year, look, it's been good. It's been good. I kid you not. I have shortly to go to a personal trainer session. So I'm going to get a move on here because I am way behind. It's been good. Now, did I do that? No. But let me give you another mental insight, which is really important for you to understand. If I buy NVIDIA stock, I don't go to their offices in San Francisco and say to Jensen Huang, let me tell you how you should run your company. Put another way, I don't buy a dog and then bark myself. If I've bought NVIDIA stock and I've hired Jensen Huang to make me money, I let the bugger get on with it. Got it? And I sit on my fat ass and go to the gym. Guess what retail clients do? They suddenly discover that they know how to run Apple better than Apple knows. Well, why the hell did you buy the stock then? Because they ain't listening to you. Incredible. By the way, everything I've just said, it's just paraphrasing what Steve Jobs and Warren Buffett said. Every single thing I've just said. I didn't even think of it. Well, I did think of it, but bloody hell, when they said it, I knew I was right. Before then, I thought I might be right. Knowing they said it, yeah. Private investors, they mess it up. I could give a private investor a goose that lays the golden egg. And in 12 months, I'll say, did you make your money? They'll go, no. I go, why? They'll go, oh, after the first month, I panicked and I got a bit bored, so I killed the goose. Well, what about the eggs? Oh, I ain't got them, mate. I'll give you a classic example. Microsoft 2021 went up 50% that year. Why did nobody make 50%? Or hardly anybody. Because for 9 of those 12 months, it was either falling or flat. Goose that lays the golden egg, you'll kill the goose. You won't wait for the egg. Panic and boredom. Panic and boredom. Now, I would love to teach you to trade. That's the gambling side of stuff for most private investors. I'm not going to, because that's not a trading webinar. And it's, you know, intellectually it's interesting, but we're not trading. We're not trading. Okay. And you can get lucky trading, but we're not trading. We're investing. Guess what the hardest part of investing is? Sitting on your backside. But you can only do that if you've got quality companies. This is exchange traded funds. I'll do a separate video on those. Look at crypto. They've taken a bit of a whacking. Check them. That's what's whacked you. But then again, you bought crypto for the long term, presumably. So relax. Okay. Exchange traded funds are baskets of stocks. They're index trackers. But guess what? They can be more volatile than individual stocks and give you poorer returns. So don't just assume trackers are better. I'll give you an example. India. Okay. Now, until that starts moving up, I wouldn't really be looking at the earliest I'll look at it is that. But here's the surprising stock. So that's an exchange traded fund. Before you all think Alpesh has just said buy India, I haven't. What I'm saying to you is this. Look at that rate of growth. Now look at that rate of growth. Let's say that rate of growth were best case to replicate itself now. I'm afraid that's only a 20% return in 12 months. It's not a big return compared to securities. So there's a price to be paid by going for what's on the tin or the narratives and the sexy stories. And you might say, Alpesh, you traitor, you're Indian, aren't you? And why, how dare you say that about India? I'm not saying it's bad. I'm saying it's very good and country's doing well. I'm proud to be of Indian origin and a British national and patriotic to being British as well. But my point is, numbers are bloody numbers. They ain't putting food on my table. 20% per annum isn't for me. And I'd only get in once it starts rising, and it might still fall and people might get bored. Look at the periods of boredom. That's boredom. That was what's called the underwater period. The ulcer index is the depth of the drawdown multiplied by percentage multiplied by the duration. That gives you a big ulcer. I want low ulcers. Oops. There's one thing you can do with exchange traded funds is you can exit 50% on a mummy bear, 50% on a daddy bear, and only buy if it's in the bottom half of the graph and it's rising. So that's your entry rule. Okay, I'll just give you the rules really simple on exchange traded funds. If it's in that half and rising, you can buy. If it's in that half and it's falling, you sell 50%. And if it becomes a daddy bear and crosses the moving average, you sell the other 50%. Simple. That's it. If you follow that, you'll be as rich as ever. Does it guarantee to work every time? Of course not. Does it work more often than not? Yes. Why don't people do it? TikTok generation. Who's got the patience? No one. It's like gym membership. We all sign up. Do we go? Do we bugger? Okay. Forgive my language on this one. Hang around too many people in the markets. Markets over the past year. Well, that's the reward for sitting on your backside and doing nothing and sleeping all year. 26%, 27% on the NASDAQ. You know, when people go, can you beat the S&P? I think, well, why have you got such low standards? You should be asking, can you beat the higher of the NASDAQ, the S&P, or an absolute positive return. What about 2022? Can you be the S&P? What? Can I be down 19%? Yeah, all right. What's a stupid thing to ask? Whenever anybody goes, can you beat the S&P, I know that they know nothing and they're going to cost their family a lot of money. Because actually, you shouldn't be asking that. You should be, why have you not got high standards? Why should you not be asking, can you beat the NASDAQ? Or an absolute return? And over what time frame? Over 1 year, over 2 years, over 3 years, over 2 minutes, 3 minutes? But like I told you, it's really easy if you want to beat the S&P. 2 times leverage, exchange traded fund S&P, over any rolling, I think it's 18-month period. It's always beaten the S&P, but not over every rolling 1 minute period or 5 minute period. I think looking back at all my education, all those degrees, I think the most useful thing has turned out to be, and I'm going to surprise you, whilst I've got these degrees in law, philosophy, politics, economics, it's been none of those. The most useful thing, now that I mention it, I've never said this before, and I've just realized what it is. It was A-level mathematics statistics. So I did pure and applied mathematics, and it was and statistics was just 10% of that A level. Everything else was pure and applied. It was statistics. It was the 10% of statistics, and only to A level. You don't need it at degree level. That was it. I've just realized that is the most important thing for investing. That, and I'm going to tell you something else for those of you. It's a really thin book. It's called Thinking About Thinking. Before I went up to university, I was told by my tutor, read Thinking About Thinking by Anthony Flew. It's that thin. The guy with the daughter, get her to read it. It's phenomenal. Thinking About Thinking. People just don't think straight. Okay. Well, guy, I've been holding XRP for 6 years. I think we only broke even this year, didn't we? That's price earnings ratio. This is US markets. Guess what? Market capitalization, the worth of US companies is 70 trillion. Let me put that into some kind of context. UK GDP is 3.6 trillion. Indian GDP is 4 trillion. The total market capitalization of US listed companies is 70 trillion. It is 20 United Kingdoms. Yeah. If the United Kingdom joined the United States as the 51st state, the United Kingdom would be the poorest state, both on GDP per capita and income per capita. It would be poorer than the 50th American state, which is Alabama. If Canada joined as the 51st state of the United States, Canada would be the poorest state, poorer than Alabama. Don't even ask about California or Texas. They're too rich. If you need to ask the price, they're too rich. So market capitalization has gone up 19%. Profits have gone up 16%. When I was doing my Bloomberg TV show, I knew that was the most important thing. Are profits keeping up with market capitalization? They weren't during the dot-com bubble. Bubbles only happen for 3 reasons, remember, because companies only have 3 sets of accounts: P&L, balance sheet, cash flow. The dot-com bubble was because profits weren't there. That's P&L bubble. Balance sheet bubble is financial crisis because mortgages weren't worth what they were said to be worth on the balance sheet. And cash flow bubble or market crash is COVID. Got to shut your shops, no cash coming in. Okay, 3 reasons for bubbles. What's the bubble at the moment? It's not one of those 3. So don't know. It'll only be technical, in other words. It won't be structural or fundamental. Technical just means statistical. Are we going to get a 10% drop in the next 6 months? Yes. Make the note. You read it here. Alpesh said it. Why? I'm just playing the numbers. Statistics. Alpesh, that's cheating. You're not looking at your time machine, your crystal ball. Nope. Right. Market cap. So that's fine. But revenues have gone up less. Why is there a big gap between profits and revenues? Well, it could be productivity increases, cost cutting, sackings because of AI. I don't know. I'll keep an eye on it for you, but that doesn't worry me. Okay. You said be patient. I've been Guy, I'm telling you. Look, either it's going to be worth nothing or it's a Picasso. We don't know. I've got my hopes still with Ripple. Price to earnings, forecasted growth. This doesn't bother me. That's the valuation. That's the growth of these sectors. I don't look at this. I don't look at sectors. I look at individual stocks, as you will know. I better run through this quicker. But do I own these? Yes, I happen to. Okay. It just so happens. What's happening at the moment? Now, I don't own the Korean ETF, but Korea is having a blinder. Artificial intelligence obviously is, but project forward those ETFs. You can see the ticker symbols here. The growth isn't as great when it's put into a bundled tracker as it would be if you cherry pick the individual securities. So just be careful about that. Okay. Be careful about that. So I put a whole load of numbers there. I don't own any of these, just so you know, for full disclosure. I don't happen to own any of these. Okay. That's the NASDAQ. Where is it? Still a bit high. I got to rush because I got to get changed and go to, I train with a Polish personal trainer under railway tracks. Literally under railway tracks. NASDAQ 100. It's like a scene from Rocky. Says the chubby middle-aged man. Look, could this continue going up? I think there is a possibility this could go up. I'm going to put that at 50%. I think this could do what gold and what Bitcoin have done, which is go exponential, but with drops like this. Okay, so this is what a daddy bear looks like. You can exit half early if you want. At a mama bear, the danger is it keeps going up and you've just exited half and you got to buy back more expensive later, right? If you're risk averse, you'd exit when that happens. We're not even there. And the other half on a drop. Now, where are we? Could it keep going up? Yeah, it did it here. Look, when that happened, it just kept going up and up. So it dropped, went up and went up. This could keep going up. I don't know. All I know is I'm in. Do I need to buy more? I could if I want. If I'm risk loving, yes. Would I hold? Yeah, because I haven't got a sell signal. What's my sell signal? Well, the earliest sell signal would be a mama bear, which is a falling MACD, and we're not even there. So I don't need to make the decision today. Very simple. Do you see how I made that simple? And then I go out and smell the roses, or I talk to you good people. What do most people do? They don't do that. You know what most people do? They spend hours and hours trying to get it perfectly right at the exact top and bottom. I'm going to show you from a multi-billion-dollar hedge fund in a moment, a slide which shows you don't do that and why you shouldn't do it. So the FTSE 100 is interesting because it might be the candle in the, the canary in the candle storm. Okay. Look how it has broken above and kept rising. And I think the NASDAQ might well do that. It might just, because it sort of has, just keep rising off the back of, now, if you want a narrative story, AI is what's doing it. So I'm happy with what I hold. In fact, I have a massive regret with what I hold. My biggest regret is I don't have $1 trillion. Because if I did, I'd be putting it all in the NASDAQ and I'd be doing well. But then again, I'm sure you all have the same regret I have, that you don't all have $1 trillion. What can we do? That's why we're keeping each other warm and companied. Okay, so that's what's happening with the FTSE. And I think that is what could. There's a 50-50 chance it's going to keep going. Now, I happen to own this. Don't buy leverage. It would be incredibly irresponsible for me to tell you to look at leverage. And I'll tell you why you shouldn't have leverage. Because look at the drawdown depth. There's your ulcer. Depth in percentage terms multiplied by duration of being underwater. That's your ulcer. And that's a big bloody ulcer. Okay, now, the fact that I say to you, well, you'd exit if that starts falling 50% and 50% on a daddy bear, i.e. crosses below, you ain't going to do that. That's like me saying, hey, get gym membership, you'll be fit by the end of the year. And by the end of the year, you have a heart attack. And I say to you, why the hell have you got a heart attack? You go, oh, that thing you told me to do, I didn't actually follow through on it, which is to keep an eye on it and do what you actually said. I just bought it and then I didn't look at it, like my gym membership. Well, no wonder you got a bloody heart attack. So I'm going to tell you instead, don't get the gym membership. Don't do the 2 times leverage. Okay, I happen to have this as well, but that's for me because I know I'm going to look at it. It's why one of the reasons I do webinars. I think I'm going to bloody look at it anyway. I might as well share it with you guys while I'm looking at the damn thing. Okay, and don't forget ulcers. I've got a greater tolerance for ulcers because I'm old. I've been doing this long enough, so I don't mind the drawdowns and the durations. Retail clients don't have any capacity for ulcers. So they panic, they get bored, they jump ship. When I've got quality companies, I don't mind this happening. Couldn't care less. Because when you're old, one thing you know, time moves faster when you're old. So I turn that to my advantage. Everybody says when they're old, they go, time seems to move faster, doesn't it, when you're old? Yes, here's a great advantage. Buy shit and do nothing. I mean, not shit, this is really good. Pardon my French. This is really good. I don't mind holding it. But it's not good enough. I'll tell you what's good. Statistics. Apple can drop 10% in a day. If it does, I'd want to buy more. Look at that chart. What does that tell me? To me, it says buy more when it drops, not less. When you find histograms like this, you want to do it. Guess how many companies out of 10,000 are like this when we go through it for our clients? About 10 out of 10,000. It's not my fault other people don't invent greater companies. They just don't. They just don't. No, Thinking by Anthony Flew, not Grant Snyder. Anthony Flew. Flew as in one flew over the cuckoo's nest. Okay, Anthony Flew. We've got a lot more to go. There is no way I'm going to be on time for my gym session. Occidental Petroleum Corporation. I won't get this yet. Okay, it is one I'm keeping an eye on. I know Warren Buffett's bought a shed load. This is a market update. I'm just saying to you because I think that needs to flatten before I'd look at it. And those numbers suggest I'd certainly want to be cautious. Warren Buffett has it. Where am I at the moment and all of this? I'd rather do this. I'm a bit risk. Sort of, I'm not fully here where I just buy everything and anything. Okay, Nvidia, because it's popular. Yeah, it hits a lot of our value growth income numbers, but I know it's overbought. And could it keep rising? Yeah, because look, it did it before. It broke out into a whole different level with AI. Is it going to continue doing that? Might do. I mean, all these people. 11th of November, Goldman Sachs said buy. No shit, they said buy. The price earnings, it's cheap. But this is the point where people panic. That's a 30% drop. Not me. I want to buy more. If I don't want to buy more, I shouldn't be in it. Now, here, I can adopt the daddy bear rule and exit and buy back cheaper later. I'll make the decision when the scenario happens, not beforehand. So when it happens, I'll either decide I'm just going to buy more like this, or I'm going to get out and buy back cheaper later, but I take the risk that I might buy back more expensive later. But once you can only do that if you've got a company which ticks the box of value, growth, income, cash flow, Sortino, alpha, and return histograms. Why don't I panic? Because I know it can do this. Small probability of a big drop means more likely to cause mass panic. Yet, this perspective prevents panic. I'm going to use that. The 3 Ps. Perspective prevents panic. Even better. Probability perspective prevents panic. Just thought of that. Genius. I'm going to forget it. Probability perspective prevents panic. That's really good. That's what this is. I swear to God, I'm lost in the investment world. You've got 3 times leverage. No, it's not a wise decision. I'm sorry, Alistair. It's not a wise decision. 3 times leverage does not move the way you think it does. 3 times leverage does not replicate the way. See, 2 times leverage replicates the underlying. 3 times doesn't. 3 times goes willy-nilly. Something can move like this, and 3 times leverage will go like this. It's mental. I wouldn't do it. You might get lucky, Alistair. It's like saying, Alpesh should just put a load of money on black. Good decision. But I don't know, Alistair, but personally, I wouldn't do it. Guess what? You might make loads. 3 times leverage. Have a look at the charts of 3 times leverage. It does not move in the way you think it does because statistics and volatility matter. Statistics. Just get a textbook on A-level statistics. It's so useful. Novo Nordisk, not yet. Not for me, not yet. We'll do in future at some point because I think it will resume that. Whoa, isn't that great? Because I'm going to triple my money at some point. Not yet, though. I certainly need that to be rising yet. It'd be really interesting to see if this hits 44. If it hits 44, wow. It's like that scene from Trading Places where he goes, I can see them. It's Christmas is coming. They want to buy stuff for their soybeans. Don't sell the soybeans yet. They want to buy stuff for their pork bellies. Watch Trading Places. So we'll see. But just out of interest, it's 44. But I'm not in it yet. I want you to see this percentage of US equity funds underperforming their benchmarks over 15 years, 93% underperformed over 1 year, 78% underperformed the benchmarks, 78%. Okay. So many underperform their benchmarks. Those who even get lucky over 1 year, like some of the value funds, guess what? Over 3 years, 90% will underperform. So the chances are you're going to underperform the benchmark. Eugene Fairman, Nobel Prize in Economics, please do it yourself. Stop trusting these fund managers. Gold versus S&P, that's where we are. I just thought I'd show that. Gold return is minus 44%. The S&P is 2,593% from 1980 when Ronald Reagan was presidente. Why am I US focused? I'm not. It just so happens that if I look through 10,000 companies, the ones that make the cut happen to have an American passport. If they had a British passport, I'm not racist when it comes to stock picking, or not racist when it comes to anything, I don't think. But He says backtracking quickly, but the point being, I don't care what nationality they are. Just so happens when I look through town, a lot of them are listed in America. What can I do? It's not my fault. I wish they were listed in Britain. I'm British. But here's the good news. I've got a bunch of Americans working for me. I bring the money back to the UK and then spend it on personal trainers from Eastern Europe in London. Surviving a bear market, what's going to happen in the future? You're all very well talking. That's 20 years ago. Don't worry. Barclays invited me to talk about bear markets then. American Express invited me to talk about bear markets then. My point being, I've got experience. I'll lead you through it. Alpesh, I don't think you meant to put that slide up. Isn't that a different presentation? No, that is me in GQ. I don't know what happened to her, Emily Blunt. But I'm all right. Lost a bit of hair. Progressive Group, not yet. I will in future, I'm sure, and capture that gains again, but not at the moment. Why? Because it's one to watch. T-Mobile's one to watch. Not yet. Wouldn't do it yet. Anybody on my program going, oh my God, you're giving the Holy Grail. No, I'm not. I'm just saying what I wouldn't buy. Yet. Republic, not yet. Might never heard of it, but boom, boom, boom. Yeah, that'll do nicely. What's that? Doubling your money in 3 years? 4 years? That'll do nicely. Thank you very much. But not yet. Want that to start. So I'll have to wait. Patience. Always have something up your sleeve to wait for. Remember, someone to love, something to look forward to, and something to do. They're the three essences of happiness. So for me, something to look forward to, the time when I might buy those stocks. For clients, what we're trying to achieve is this, annualized return. We look at all these different returns. We look at these volatilities. We convert that into doubling time. We say to ourselves, okay, 30% annualized return on a portfolio means you double your money in 2.3 years. But would you rather not have less volatility and maybe just double it in 3.5 years instead? Take an extra year, okay, but have less volatility. Of course you would. And that makes my life easier and theirs easier because less volatility, less ulcers. But you also want to look at what's the probability of being down after a year. You see, everybody's greedy. But if you told them the probability of being down after the year is 24%, they might be, whoa, what a waste of time. Guess what? Probability perspective prevents panic. Seriously, I'm going to trademark that. Did you know I actually had to trademark my name at the patent office because people on TikTok were using my name, and the only way to get them removed quicker is to call it an intellectual property violation as opposed to somebody is scamming by copying my name. So I actually got my name trademarked so I could then show TikTok intellectual property violation. You know why they hate intellectual property violations? Because that's a civil offense and they could be sued, whereas scamming people is a criminal offense and that's up to the police, and TikTok wouldn't get sued for that, prosecuted for that. Anyway, Warren Buffett, Goldman Sachs. That's the Goldman Sachs portfolio. You wouldn't probably go too far wrong looking at that. Warren Buffett, I wouldn't buy this now. I mean, I don't know since when he's bought Chubb, but it's interesting he's added a bit more to it. The fact that he's reduced Apple is rebalancing. It's not because he hates the market. It's interesting how much he's bought of American Express. He's had it in the past as well. NVIDIA is new for Goldman Sachs. If you're wondering why NVIDIA shot through the roof, is Goldman Sachs have belatedly decided, yeah, it might be all right there. Same with Broadcom. In case you don't know, yes, I do happen to own those. I've been writing about all of this in the Financial Times and so on. That was 2004. Okay, so these are all the books. Don't go out and buy them. You don't need to, because I'm now in the age of the internet and I can tell you all of this stuff. Do connect with me on LinkedIn. There's still a bit more to go. It's me with the team, me gallivanting around the world. None of my political education, none of my legal education, none of my economic education made a difference. Everything that made a difference, I'm showing you on here. Value growth, income, cash flow, Sortino, alpha. And the fact that algo trading has dominated the markets is all the more reason for patience and not panic. All the more reason for patience, not panic. Because the algos are now moving things and causing more and more and more noise. All the more reason for patience, not panic. But you can only be patient if the companies are profitable. Why? Because the world, well, private investors still care about profitability. I'm going to have to really be quick now. Artificial intelligence, all this thing, pattern recognition, all actually essentially we're doing is we're saying when there's a pattern of profits, high growth, dividend yields, that pattern suggests stock prices move up. If you think about it, common sense tells you the same thing. So all we're doing is using AI for more pattern recognition. Has it improved our results? No, I guess it's thrown up names which we might not have done. It's given us other model portfolios which have actually done better than mine. But is that because of AI or is it coincidence? I don't know yet. But it might put me out of a job. We don't need to explain that. In one sense, trading is about this, but investing is also about this. Investing is also about this, is that if there's a 50-50 chance of something, you might make nothing. All we're trying to do with investing is increase the odds slightly so there's an increased probability of that rather than this. That's it. And we're trying to increase it to 60-40, not to 100-0. Do you understand? That's what it's about. And I'm going to take something from the trading world and give it to you in, this is from Man Group, Man AHL, multi-billion-dollar hedge fund. And this is these are their slides. Okay. And this is in essence what we're doing. Do we go long or do we go short? Or short means exit in our case. Okay. And that's all they're doing. Now, they're looking at these factors of trend moves. All we're looking at is factors of value, growth, income, cash flow. So, Tina, these aren't my slides. These I've stolen from Man Group, which is a multi-billion-dollar hedge fund. Okay. Now, they've got their factors. They've oversimplified it. They don't literally do it like this, but it's similar to this. And the reason they go partly long and then add to winners is exactly what we do, except our factors and inputs are not trends alone. It's value, growth, income, cash flow. This is from Winton Capital, a multi-billion-dollar hedge fund. And notice how they buy after the event. They don't try and do here. This is what retail clients do. They get in here or get in there. That's stupid. Okay, because you'll never succeed doing that. A multi-billion-dollar hedge fund is telling you buy there or you sell after a lag. That's what all we're doing. We don't have a crystal ball. So if you don't have a crystal ball, that's what you end up doing. Okay, this is from Hathersage Asset Management, which is run by a friend of mine, Bill Lipschutz, multi-billion-dollar hedge fund manager. And guess what? This is what our distribution returns would look like. You'll get a few big outliers. If we could have a crystal ball, we'd only have those and nothing else. And we'll get a load of losing ones and a load of winning ones, which will cancel each other out. And the returns will come from the few. 80-20 rule. And investing it often is the case as well. What private investors think is we get everything right and everything's big. Well, if it was that, we'd just have one investment. And they don't understand. This, again, not my slide. It's from Bill. And it's what led me to be, well, this is me back in the day, 2004 again. I think I must have peaked in 2004 when I won that competition in the Financial Times to forecast the markets. This is more recently where I've been lobbying lawmakers probe of British stock pickers, broking giant. There was a broker that they were probing, and I gave a quote saying that, yeah, these fund managers are a danger and lawmakers need to look at it. Patel said best buy lists across the industry were great little business because you're getting paid regards to the fund's performance. The fund's performance is just awful, time and again. And we've got to stop this. And the lawmakers, I can't remember which stock picker and broking giant it was. I think it was Hargreaves Lansdown, actually, that they were probing because of what's his face, Neil Woodford. I think it was the Neil Woodford investigation. Follow me on YouTube as well. That's gold. When that falls and goes back to a longer term trend, there's going to be a great opportunity to short it, but that's a separate issue. Could NVIDIA do this? And the S&P 500? I think there's a 50-50 chance it might do. By the way, are we overvalued? Well, Goldman Sachs says no, and these are the reasons given. Have a read of that. They don't think we're overvalued. I don't care whether we're overvalued or not. I don't need to make the decision to sell today, so I'm not selling. Okay, I showed you that earlier. You don't need this. I think I've duplicated some of the slides here. Retail clients, please be careful. Okay. If you were surely the makings of a billionaire, that's me, age 6, playing chess with my uncle. 19A Kellett Lane, Leeds. My first computer. Logic. Please teach your kids how to use that. That book isn't out yet. It's going to be published by the Financial Times. It'll be out soon. This is what a $1 billion portfolio looks like. Small losses, small wins, few big wins. If we could only get those, we'd be laughing. Our job is to avoid those or make sure there's too little money in them. Take this from Soros. It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong. Okay? And you can beat overpaid fund managers like him. He narrowly beat Jasper the Cat. So I want to give people, that's Bill Lipschutz, who I interviewed for my very first book 30 years ago, Mind of a Trader. I do want people, and remember this quote, I do want people to do it themselves. And I'm trying to encourage them to learn to do it themselves. If you've got an IQ over 120, wasted investing, said Warren Buffett. All of that education, in many ways, was wasted in finance. Well, everybody who goes into finance is a waste of space. But we should be saving lives and being soldiers or doctors or nurses. But I didn't have the capacity for all of that. That's Mummy. There's something else I want to show you. Some of these are old slides. That's it. That's the due diligence. Okay. Value, growth, income, momentum, trend, statistics. I hope that's come across. You got all of this data available to you. Do not be put off by it. We're not going to use all of that. We just want to tick a value box, any growth box, any income box, any momentum box, and then have the mentor double checking it for you. Okay, there's lots of tools to do that. This isn't a list for today, by the way. These are old slides over there. And one of the things that we're trying to avoid at the portfolio level, as you saw with drawdowns, is we don't want a drawdown ever to be below 20% because it means you've got to go 25% up. That's why ideally for drawdowns between 20 to 15, you only need the portfolio to recover that much, which isn't much, even in a year like 2022. That's easy to do. Read that. Incredibly important. The Nobel Prize winners were these. They're the three that I rely on all my work. Okay. This doesn't matter so much. I've got men, be careful. You tend to be more overconfident than women. Women make better investors, though they have less money. Society has made it that way. Unfortunately, what is also the case is that Swedish middle-class, middle-aged housewives, and I'm sure we're all trying to meet more of them, have rational expectations. They tend to make better investors. They tend not to be overconfident. I don't know these two Swedish housewives myself, but it's a serious point, actually, funnily enough. They tend to be better investors. Wouldn't it be better if they had lots of money? Luckily, those two are billionaires. That's the holy grail for me. It's value, growth, income. Decide how much is in cash, decide how much is in there. And I want you to have a look at not just the YouTube channel that I've got, but also all the free tools that I've got at Campaign for a Million, because you'll find the blog, but even more importantly, you'll get the investment tools. All of these are free. Pension calculator, safe withdrawal rate, portfolio stress test, depending on how much money you've got, what are the chances of how much it could drop, what age you can retire, lifestyle calculator. This is incredible. All free. Okay. All free. Campaignforamillion.com. It'll tell you between your age, retirement age, life expectancy, annual growth rate, where you should be at, whether you're American or British. I've used as models on there. So have a look at that, because the massive poverty gap I'm trying to stop is that the Americans are getting so far ahead. They grow more, and the British tend to be getting zero in their pensions. So we've got a proper crisis, because the pension fund managers like St. James's Place are absolutely destroying this nation with poor growth. Whereas what they should be saying to their clients is, look, we're shit. Please, we're going to teach you how to do it yourselves better. Okay. And this is a typical fund. And what a typical fund will do is generate that. And after 5 years, it'll be 10% in fees. So please learn how to do it yourself and teach your kids how to do it yourself. I like Koifin. There's a lot of data there, but don't be put off by it. Value, growth, income, cash flow, Sortino. That's a good reading list. Take a photo. I told you earlier, get a camera phone. These are my reading lists for you. This is what I'm aiming for people. If they can get a 10% improvement, that would mean an extra 25,000 on a 250,000 portfolio. On a 500,000, it would mean a 50K improvement. And if that happens once in 10 years, you get that improvement, and the rest of the time you're mediocre, still extra 50K in your pocket. It's all I'm trying to achieve through the education. And that's what we're trying to do with those portfolios. It's all we're trying to do is generate that. How much do you need to retire? Look at those tools I gave you, but annual spend times 25 is the general rule. Don't worry about that. What's your retirement number? We've got this on the tools, campaignforamillion.com, where it'll tell you if you want that much money, that's how much you need. But now we created the app, which makes it more specific to your own needs, campaignforamillion.com. It's over there. What's the different growth rates make 100K over 15 years? Well, if you got 5% per annum, that's what you end up with. 15% per annum, that's what you end up with. 30% per annum, that's what you end up with. Obviously, 30%, forget it. You're not going to get that. But look at the improvements. You've got so much more money. That's a UK growth rate. That's just an index tracker rate. And that's 15 years. And the time will go like that. That's why growth matters. Growth matters. It is the magic bullet. You can't get younger. You can't save more money. You can't earn more. Can you grow more? Growth is the magic bullet. And here's how I cheat this. Frequency of 2-year S&P 500 returns since 1950, average positive return, 32%, 88.5% of the time over a rolling 2-year period. I'm not the clever one. I'm just patient, okay, in quality companies. So we do even better than that. If you need a way to sack your IFA, take a photo of that. That's what you tell them. We got ChatGPT to write that and tell the IFAs. If your IFA is St. James's Place, that's what you tell them, okay? And take a photo of that, and that's how you get rid of St. James's Place. Like I said, that for us is the holy grail, how we vet it. That's how we did in 2024. As you can imagine, 2025, markets went up. It's going to be a bloody good year as well. I don't know if that year will ever happen again, okay? This is not typical. It is not typical. That was 2023. It is not typical. This is an ad we're getting ready to run. It's not finalized yet. Okay, just move my money out of St. James's Place. Like I said, these are the factors. This is what we're after. Now, look, you don't need 20% because you double your money in 3.8 years. If you can get the index tracker, it's still 5 years. What's the difference? 1.2 years. Don't be greedy because the extra volatility in the ulcer might not be worth it. What we're trying to do is get 30% return portfolios if we can in good up years like this year, but we don't expect that to happen. Because if we do half as well, then we still get 15% per annum, which is the long-term index tracker return anyway. I'll still be happy with doubling it in 5 years. Okay. If you want to be part of my program, I take on 10 people when I do webinars and you get the webinar discount. If you want to be part of the program, you're welcome. If you do want to use the free resources, do. In the program, you've got me mentoring you for life. It's a one-off cost. It's one-off. And you get access to all the data and me for life. I've got a whole team who creates all of this. You get access to all of this and the model portfolios bespoke to you and access. We don't manage your money. You manage your money with whichever broker you use, just to be absolutely clear. So it's even better. It's education, data, information, mentoring, hand-holding. Okay. Thank you very much. I got to go. I got to get to this gym. Okay, thank you very. Oh, I've got a whole load of files to give you all. Let me turn those files on. Okay, let's share those files. I want to do that. I hope you've enjoyed it. Keep the questions coming because they'll come into my inbox. And then what I'm going to do is I'm going to answer them a little bit later. Okay, so do keep them coming. And we'll take it from there. Thank you very much. I hope you enjoyed it. It's a bit longer than normal, so forgive me for that, but I hope you did like it. Yeah, I never have a good, I think hopefully it's going to be a shortened session. She's going to kill me today, but thank you all for being on. I appreciate it. And I hope to, see you on the next webinar. See you at campaignforamillion.com. We've got a ton of information. We even do free pension reviews, education calls, free pension education calls on there. So thank you all for that as well. Okay. Thanks, everyone. I am going to get a move on. Don't forget all those free resources and free tools over there as well. He says, ta-da, that's me, and that's me signing